Oh, great to have you with us. So we'll be watching what happens with NVIDIA after the bell tonight. What was interesting was watching the markets yesterday as there was that reaction to Donald Trump's dismissal of a Fed board governor, Lisa Cook. Now, in terms of the market reaction, it was relatively muted, but Fed independence is something that investors have historically paid a lot of attention to. Let's bring in Karl Schamotta, he's Chief Market Strategist at Corpay, to get his perspective on this developing story. Nice to see you.
You as well.
And, you know, I think that a lot of people have been wondering about how this sort of story would unfold and how the market would react to it. Walk us through sort of what you were seeing as these headlines were crossing this week.
Yeah, it seems sort of like the boiling frog dilemma in a way. You know, we've had this sort of drumbeat of negative headlines for months, you know, increasing pressure being applied to the Fed. The markets have reacted to some degree, but if you really look at the overall, you know, underlying price action, it has not been all that negative, right? We saw the dollar sell off a little bit on the other night when the news crossed the wires. We saw Treasury yields steepen a bit. We saw equity markets bounce you know, they bounced a little off and then they came back. All of this suggests that markets are not too worried about this. And you know, to some extent, this may be because, you know, Cook is one of 7 Fed governors, and you know, she sits on a 12-member committee, and this does not give Mr. Trump the capacity to, you know, essentially pass lower rates. The majority on the committee is still, you know, not appointed by Trump and won't be. But, you know, if we look at the sort of the bigger picture here, it does look as if increasing pressure is being applied against the Fed. The fact that the Trump administration has essentially applied the full force of the federal government against one individual on the Fed suggests that, you know, anyone stepping into a role on the FOMC in the future is going to be very, very careful about doing so. And so, to me, this means that markets are perhaps underappreciating a very big long-term risk.
You know, obviously, sort of in this period, as sort of people are trying to figure out what the president was doing and learn more about Lisa Cook specifically, you know, my thought was it's not new to see the president putting pressure on the Fed.
Right.
And so I just wondered if, you know, for a market that's had to constantly adjust to how the president does business, whether or not that is sort of in itself unique and the market has to sort of treat it as such.
The market does, and I think that's the real key thing. If you really look at history, markets and investors in general, despite all of the pundits who talk about this kind of thing, are terrible at pricing, you know, serious institutional and geopolitical risks. I posted a chart the other day on Twitter and Blue Sky, but if you look at German stock markets through the 30s, right into, you know, the beginning of the Second World War, they continued to climb. You know, even after Stalingrad, you know, there were very obvious threats to the German stock market through all that period, and the markets just failed to react to them, right? So we may be in a situation like that. And I think there's also a broader story to think about here in the sense that, you know, markets are looking at this as sort of an incremental change, but we may be on the verge of a phase change in global markets, right? If we think about the global fiat currency system that we have today that emerged after Bretton Woods in the 70s, it is a central bank-backed regime, right? We replaced gold with central banks that are presumed to be independent, right? And the Fed is at the center of that. And if we take that out, right, we are going to see increasing bifurcation across markets. We're going to see people looking for value outside of the traditional currency sphere. And that could introduce a lot of volatility that is currently clearly not priced in.
I mean, are we there yet? Like, we often have that conversation with respect to country alliances. You know, if the United States feels less friendly towards traditional allies, and that leads to sort of new geopolitical questions. You're talking about sort of the way the market operates and thinks about central banks, and whether that's called into question leads to sort of a new roadmap, a new map really, but
Yes.
we're not there yet.
We're not there yet.
Yeah.
You know, it is something that we're moving gradually toward, and you know, it could turn on a dime. We could have, you know, for example, Trump could appoint Waller next year as the new Fed governor, and I think that would, you know, or new Fed chair, I should say, you know, that would definitely instill a lot of confidence. On the other hand, you know, we could pivot in a positive direction. We could, you know, see a reassertion of Fed independence and a commitment to stability in the long run. And, you know, that could put all of these worries to bed. But, you know, there is a significant risk here that that is not, in fact, what happens.
So Bloomberg has a story today about the bond market and whether, you know, what they're describing as Trump's Fed gamble could ultimately push some of the key bond rates even higher.
Yes.
And I think that, you know, in some of the moments of watching what's coming out of Washington, we have turned our attention to the bond market because there are people in the Trump administration who do the same thing.
Right.
Will that be kind of one of the determining factors? Should we keep an eye on what the bond market is signaling throughout all this?
Absolutely. And I think that's why investors are spending so much time thinking about the curve itself, right? So yes, on the front end, in your 1 to 2 year tenors, the likelihood is that the Fed eases policy more aggressively, and so rates are staying fairly flat and contained there. But if you look at the 30-year end, it's pushing higher, right? The term premium embedded is pushing higher, and that to me reflects a loss of inflation credibility over the long run. This is something where, you know, long-term investors who have to park money for, 20, 30 years at a time are thinking about what exposure they have to sort of untethered inflation over time.
Karl, we're almost out of time, but I think we're going to be talking a lot about NVIDIA today, the stock market story, but the whole AI story. How is that rubbing off on the broader economy for people who get nervous about all this other stuff happening?
It's amazing right now. I mean, we're really offsetting signs of weakness in the rest of the economy. If you look at the housing market, the residential housing market, which has traditionally driven the business cycle, it is very soft. Consumers are soft. Labor markets are soft. Business investment outside of AI is soft. And yet we have AI investment, in infrastructure, boosting construction. If you look at it on a chart right now, data centers are about to exceed the amount of construction that's happening on the residential side of the economy.
Wow.
Which is incredible. But also, when we look at the stock market valuations, the fact that, these indices are powering to historic levels, that's transmitting a wealth effect across the American household sector, right? This is meaning that households feel richer and more willing to spend. And so what's happening here is, this really difficult to reconcile shift in the economy. And so what I'd really worry about here is at some point we get that negative earnings report from NVIDIA and the rest of the AI complex, and that leg gets knocked out from under the U.S. economy stool.
The tone changes. All right. Well, we'll see how things play out on that front. Karl, good to get you with us. Always appreciate it.
Great seeing you.
Karl Schamotta is Chief Market Strategist at Corpay.